The global automotive industry is facing an unprecedented drama that many experts are already calling the biggest crisis in the entire history of German car manufacturing. What seemed impossible just a year ago is now becoming reality. China has nearly collapsed German car sales both in Europe and in its own domestic market, pushing some models to levels close to statistical zero. According to sources cited by Financial Times, Der Spiegel, and analysts from the Center for European Economic Research, the largest German manufacturers, Volkswagen, BMW, Mercedes-Benz, and Audi, are facing something they have not experienced in the last half-century: the loss of control over key markets and a systemic decline in demand amid the expansion of Chinese competitive brands. The situation is deteriorating rapidly. According to insiders in Germany's Federal Ministry for Economic Affairs, whose leak appeared in Handelsblatt, the sales volumes of German cars in certain EV segments in China have effectively fallen to zero, not in absolute numbers, but in market share. In some categories, such as budget electric crossovers, German manufacturers hold less than 1% of the market, which experts already call zero from a mathematical perspective. Sources cited by Reuters Breakingviews note that German brands have become uncompetitive in price, battery technologies, and software, areas where Chinese companies BYD, Geely, SAIC, and XPeng are showing aggressive progress. On the European market, the situation is no less alarming. Chinese manufacturers, who just 3 years ago were seen as peripheral players, are gradually taking segment after segment. According to analysts at Jado Dynamics, the share of Chinese EVs in the EU has risen to record levels and continues to accelerate. In some Eastern and Southern European countries, Chinese brands already surpass Volkswagen Group in new EV sales. As reported by the Wall Street Journal, the rise of Chinese presence has become so fast that several national car dealer associations have warned of the threat of the complete displacement of European manufacturers from the budget segment within the next 2 to 3 years. A particularly painful blow has been the collapse of premium German car sales in China, a market that for many years was Germany's main source of profit. According to leaks published by Bloomberg Asia, Porsche sales in China have plunged by more than a third, despite unprecedented discounts and leasing programs. Analysts call this a historic turning point. Not long ago, Porsche symbolized Western status in China, but now even the new generations of the Cayenne and Panamera are selling worse than expected due to fierce competition from Chinese luxury EV brands such as Hongqi, Li Auto, and Aito. Volkswagen, long the most popular foreign automaker in China, is experiencing a severe crisis. According to Nikkei Asia, VW's internal reports show its market share has almost halved in recent years. Outdated platforms, the lack of modern battery solutions, and a delayed transition to software-oriented vehicle architectures have made the company vulnerable to the rapid technological leap of Chinese manufacturers. The problems are not limited to sales. In Europe and Germany, pressure on suppliers is growing, the very companies that form the foundation of German automotive success. According to a study by the German Association of the Automotive Industry, more than 60% of major suppliers believe Chinese competitors have gained an irreversible advantage in battery technologies, power electronics, and automotive software. Sources mentioned by Süddeutsche Zeitung speak of impending bankruptcies and mass layoffs that could affect tens of thousands of jobs in Germany. Analysts from the Center for European Policy Studies note that the crisis is not cyclical, but systemic. China has not simply beaten its competitors on price, it has overtaken them technologically. New models from BYD, NIO, and Zeekr are equipped with highly efficient in-house battery systems, integrated power modules, next-generation autonomous driving systems, and fully digital vehicle architectures. Many German cars, especially those built on older platforms, look outdated by comparison, a fact confirmed by customer feedback and by tests published by Automotor und Sport. According to the Kiel Institute for the World Economy, Germany has ended up in a uniquely difficult position. On the one hand, it depends on the Chinese market, on Chinese component supplies, and on production in China. On the other, China no longer needs foreign technologies and has itself become the dominant player in the global automotive industry. This dual pressure has created a situation that experts already describe as a perfect storm. Internal documents from Mercedes-Benz strategic divisions, a leak discussed in Frankfurter Allgemeine Zeitung, indicate that the company may lose up to 20% of its profit within the next 2 years if current trends do not change. Audi is in a similar position. According to Tagesspiegel, the VW Group's premium division sees critical demand decline in key markets and is preparing for large-scale restructuring. While German manufacturers are trying to adapt, Chinese brands continue their aggressive expansion. They are opening assembly sites inside Europe, signing contracts with European dealers, offering pricing models that cannot be matched without a full recalculation of production costs, and releasing updated versions of their vehicles every 6 to 9 months, a pace unattainable for many European brands accustomed to long production cycles. And the most worrying thing for Berlin is that this crisis is not unfolding gradually, but is accelerating rapidly. According to analysts from the European Center for Industrial Dynamics, the internal decline in the competitiveness of German automakers is happening faster than they are able to respond. Reports prepared for the Bundestag's Economics Committee state plainly that the technological gap between Germany and China in the EV and automotive software segments not only exists, it is widening at high speed. Over the past 2 years, China has skipped several stages of development that German manufacturers had planned to complete by the end of the decade. The situation with battery technologies has become especially revealing. Chinese companies CATL, BYD, and CALB not only dominate battery production, but also control most key patents. In one leak published by Die Welt, a former Audi engineer said that German teams are fighting to optimize platforms while Chinese manufacturers create new architectures every 9 months, and their speed is a disaster for German companies. German developers, accustomed to multi-year design cycles, were unprepared for the Asian model of lightning-fast iteration in which a product is considered outdated a year after release. Meanwhile, social tensions inside Germany are rising. The closure of production lines, staff cuts, and relocation of manufacturing abroad have caused unrest within the IG Metall Union. In its latest report, the organization warns that if current trends continue, by 2030, Germany may lose up to 300,000 jobs in the auto industry and related sectors. This will lead not only to economic damage, but also to a deep political shift, as the automotive sector has always been a foundation of the German middle class. And if in the coming years the industry does not undertake deep modernization, accelerate the introduction of new technologies, reduce dependence on China, and develop competitive next-generation EV platforms, Germany risks permanently losing its status as a global automotive leader. And if nothing is done, what we are seeing now may become only the beginning of a much larger and more destructive crisis.